Good afternoon for those of you who are watching this quick video. Maybe it's morning, whatever time it is. Thank you for your precious time, which is your most important asset. We can always make more money, but we can never make more time unless you know something I don't. Okay, let's get to it. There's a lot of talk that I'm hearing about interest rate rises. So if you are someone who could be thinking, you're concerned about interest rate rises rising and how that'll affect you, and you are a property investor who is either currently owning and controlling investment property or looking at acquiring an investment property. Because I've got a client that I'm working with at the moment, and the topic came up around, oh, maybe I should wait for interest rates to drop and then buy, which to the less experienced property investor, from my experience, and what people that I know do very well in investing in property, is not the primary focus. If you want to know how interest rates are secondary in relation to working out if an investment property is the right way for you to go with what you've currently got or in the future, now or anytime, come on this journey with you and I'll explain to you why it's not the primary focus and what is the primary focus, okay? And let's go on a journey. All right, thanks for watching. Trevor Russell. All right, so firstly, let's look at some estimates here. Let's say you're acquiring the controlling position of taking control of an investment property, which is what we're doing. We're acquiring an asset that is an income-producing, capital appreciating asset, right? And interest rates and tax deductibility and all of that form part of the overall assessment, okay? So let's look at this property. Let's say we're acquiring a property for $520,000. We are borrowing up to 90% of the property value, which we have a loan of $468,000. There's lender's mortgage insurance, which what we call capitalizing to the loan. Thank you for those who already know this, just so we're clear on everything that we're doing here. And we've got a total loan facility of $477,100. Okay. Now, you may have funds sitting in an offset account, which would lower that loan amount and in turn repayment, but that's for another video. Okay. But let's say for now, to acquire that property at a 10% deposit, we need $52,000. Costs around $19,000, let's say $20,000, but $19,924. The investor needs $71,900 odd to acquire and take control of that $520,000 asset. Okay, thank you for your patience. All right, so now let's look at this thing called interest rates. And does it matter? And yes, it matters, but what I look at as a property investor and what I know people around me look at as a property investor. And firstly, it's this. Can we afford to control this investment property asset, and can it meet our affordability? Because we may have some out-of-pocket expenses, and we need to know as responsible brokers representing our clients that they can afford it. And secondly, can the client feel comfortable with it, taking everything into consideration, not just, oh, interest rates are going up and I better not buy yet. And here's why. Let's just say we're working on an interest rate of 5.5%, which would be a principal and interest payment of $2,708 per month or $32,496 per year. Let's say there's a package fee, which is pretty standard for the majors, and we've got rates and some maintenance, and I've estimated it at $5,500, let's say, okay? So we've got $38,391 in outgoings, and then we have a rental income. For this particular property, let's say we're renting 2 rooms out at $300. Now, this property can probably get a bit more than that, but I'm just keeping it very conservative. Better to lean on the side of conservative than being, not conservative, okay? So we're looking at a shortfall of $7,000 a year from this to this figure. How funny. Whenever I do a video, the buzzer goes, the lawnmower comes, the painter comes, whatever. But let's get back to it. Okay, so coming back to the rental income, we've got a shortfall position here between the outgoings and the income, and we're looking at about $138. Okay, now if you're FA with negative gearing and working out these figures, you would know this. But here's the other things that I think are important for you to either be reminded of, or if you don't know this, what we are missing out on if we are waiting for rates to drop, client specific, goal specific, okay? But for this particular client, they are in a position to be able to afford this shortfall, and they are in a position to be able to control an asset of this nature for their financial position. Now, if this client waits because they want to potentially save a couple of $1,000, let's say, in saved loan repayment, interest rate repayments, that would be because of an increased rate, and we don't even know if rates will necessarily be coming down, this is what we miss out on. Because remember, we are acquiring or purchasing a capital appreciating asset that produces income, okay? Again, client specific, asset specific, but this will be a very, very nice performing property. I know the one that the client's looking at, and this will go up in value. It's in a good area. And we are in one of these times in Australia where the right property in the right areas are not only increasing in value, but we've got a shortage of rental properties. So we're also getting an increase in rental income. Okay, so we've acquired this asset, let's say, and we've proceeded. Let's just say the property goes up 10%. We are looking at a $52,000 capital gain or growth of that asset. And we're also looking at a rental income of $31,000, and we're looking at a tax deductible expense without including depreciation and all those things. So we've achieved three very nice things here if we acquire the property. If we don't, because we're waiting for interest rates to drop, right? We might save a couple of $1,000, but we're missing out on $52,000. We're missing out on rental income. We're missing out on tax deductibility. And here's the other thing on this. Again, client specific. Not only do we, if we wait for a potential interest rate drop, guess what? Let's say we go and try to buy the property in 12 months. We're not acquiring a $520,000 property. We're acquiring a $572,000 property, which means we have to come up with more deposit and potentially more serviceability income to acquire the property. Now, I hear what you might be thinking. Oh, do you know properties will go up in value? No, I don't. I'm just going on what I've seen has happened over the years of property. Sure, we had a big drop with the GFC. I had a finance business at that time. I know very well what it was like. I had 5 properties that I was controlling and invested in, and it was a tough experience. Learned a lot from that one, by the way. Okay, but let's just say if future predictions, future returns continue, and I personally think 10% is quite conservative, actually. I think we're looking at least a 15%, but I'm only making estimations here. I'm not wanting to predict the future. All I'm wanting to get across is if interest rates are on your mind and you're thinking about buying an investment property, just be aware of looking at all the factors and how a property investor, and this is probably could be you, is we want to take all things into consideration. Firstly, can we afford to control the asset by buying it and controlling it, renting it out, doing all of that? Is the asset going to give us good capital growth? Because really, in effect, that's what we're acquiring the asset for. And we're also acquiring it for rental income to help us control and manage this property. And in time, with rental incomes going up, we're paying down the loan. I always like to do loans personally at P&I. Someone might kick me for that, but I want to build equity into my assets. And I suggest it to my clients. You might want to do interest only for a few years. But anyway, let's wrap it up. Time out. Hope you found that helpful. Do interest rates matter? Client specific, possibly. But if you're a property investor and you're looking at this as a complete investment, I would just have you consider all elements of the asset and what it is that you are trying to achieve longer term. Okay, looking at the capital growth, the rental income, and the tax concessions that come with a good rental property. And of course, if my team and I can help you with this, do the numbers, take a look. It would be my pleasure. I do love doing this stuff, as you probably can tell. Thank you for watching. Trevor Russell, Results Investment Group. Be a pleasure to help you now or in the future, or anyone that you know. And happy investing to you. Speak to you very soon. Ciao for now.